and I'm here to share with you about my stock account. Right now, my stock account has earned $4,180 US. All three US major indexes fell more than 4% this week. Silicon Valley Bank failures triggered a decline in financial stocks. Is the Silicon Valley Bank explosion just an accident? Wall Street's smart money has long ambushed. In my account today, including the post-market price, I've gained a total of $4,080, which is a gain of 5.11%. Right now, the net asset of my account is $83,181.89. Today, the total payout in my account is $17,199.59. SQQQ today made a gain of 4.13% to 41.08, and the RV made a gain of 9.74% to 56.02. All of the stocks indexes closed lower, and except for the drug manufacturers industry, all of the industries closed significantly lower, especially the tech and financial sectors. Dow Jones Industrial Average closed 1.07% lower. Nasdaq made a loss of negative 1.76%, and S&P 500 made a loss of negative 1.45%. With all three U.S. stocks closed lower on Friday, with all three major indexes down more than 4.4% for the week, and the Dow recording its biggest weekly drop since June. The collapse of Silicon Valley Bank and its takeover by California's Financial Protection and Innovation Division panicked investors and plunged the financial sector. The Dow Jones made a loss of 4.44% for the week, S&P 500 down 4.55%, and Nasdaq down 4.71%. The CBOE Volatility Index, a measure of panic among U.S. stocks investors, climbed to 27.6, the highest level since October 25th, on news of Silicon Valley Bank's collapse and takeover. The Silicon Valley Financial Group, the parent company of Silicon Valley Bank, is attracting attention. The group announced Thursday plans to raise more than $2 billion to offset losses on bond sales, sending its shares tumbling more than 60% on the day. The Federal Deposit Insurance Corporation said Friday that Silicon Valley Bank has been closed by California regulators, which is about $209 billion and the first insured institution to go bankrupt this year. The FDIC said its Silicon Valley Bank headquarters and all branches will reopen on Monday, March 13, 2023. On Friday, the California's Department of Financial Protection and Innovation showed that it has taken over Silicon Valley banks under Section 592 of the California's Financial Code, citing insufficient liquidity and insolvency. The FBI designs the Federal Deposit Insurance Corporation as a receiver of the Silicon Valley Bank. Silicon Valley Bank, a state-chartered commercial bank and a member of the Federal Reserve System in Santa Clara, had approximately $2,022 in total assets of the December. Had $209 billion and a total deposit of approximately $175.4 billion. Its deposits are federally insured by the FDIC under the applicable limits. News of the Silicon Valley financial conglomerate going bankrupt and being taken over sent the financial sector tumbling as investors increasingly worry that higher interest rates will cause banks to face loan losses, for borrowers to default. White House economic advisor Ramaruti said the Treasury is closely watching the possible impact of Silicon Valley banks. Remnant hedge fund manager said Thursday that the U.S. government should bail out the Silicon Valley banks. The Silicon Valley bank's failure could destroy an important long-term driver of the economy, he said, as venture capital backed companies rely on the banks for loans and hold cashes from operations. If private capital cannot provide a solution, Alman said, a highly diluted government priority rescue program should be considered. Ekman said no other bank would move to help the Silicon Valley Bank after seeing JP Morgan's rescue of Belisarius. The government can also guarantee the deposits in exchange for the insurance of diluted warrants and other contracts and protections. He said, if it's indeed solvent, it'll buy time for it to rescue franchises and raise new private capital. On the economic data from Friday, the Labor Department reported U.S. non-farm payroll rose 311,000 in February, beating market expectations of 225,000. Average hourly earnings rose 0.2% in February, below market expectation for a 0.4% increase. Meanwhile, average hourly earnings rose 4.6% in February from a year earlier, missing market expectations. Average hourly earnings figures suggest a slowdown in wage growth. The February unemployment rate rose from 3.6% to 3.4%, compared with 3.4% expected. While the non-farm payroll data grew higher than expected, the rising unemployment rate and slowdown in wage growth were encouraging for the Fed, the analyst said. Bryce Doty, senior portfolio manager at Citi Investment Associates, said the non-farm payroll data was a relief to investors worried that a 50 basis point Fed rate hike, while jobs rose from expectations of 225,000 to 311,000 stronger than expected. Average hourly earnings rose only moderately 0.2% in February. The unemployment rate rose to 3.6% from 3.4%, and even labor participation rose slightly. The series of data should calm that concern, given that the Fed Chairman Colin Powell was worried that rising wages could lead to higher inflation. Another figure shows that the federal government's budget deficit widened by $262 billion in February, bringing the deficit for the first 5 months of the fiscal year to $723 billion. Interest on government payments on the outstanding payment that is against the main driver of the deficit. According to monthly budget data released Friday, interest expenses was $46 billion in February, or about $307 billion so after this year, up about 29% from the same period last year. After adjustments, the federal deficit for this fiscal year was expanded by 62% from the previous year. The deterioration will intensify bipartisan wrangling over how to respond to the long-term budget challenges, with President Joe Biden proposing a big tax increase, while Republican lawmakers insisting on spending cuts. The U.S. will enter daylight savings time this Sunday. For March 13th, the opening and closing of the U.S. stock market will be 1 hour earlier. That is, the trading time will be changed to 9:30 Beijing time to 4 a.m. the next day. The pre-hours trading time will be 4 to 9:30, and the after-hours trading time will be 4 to 8. Is the Silicon Valley Bank explosion just an accident? Wall Street's smart money has long ambushed. Was the FDIC ordered to take over Silicon Valley banks? U.S. banks have the worst risk event since 2008. While global capital markets are stunned, a small group of investors are celebrating their smart move. SPDR, the S&P Regional Banks ETF, peaked on March 3rd after rising for months, the highest for at least a year. According to S3 Partners, a leading stock analyst platform, from the closing price on March 3rd, the decline in a week is ready to close to 18%. All comes from the Fed's water leader stopped. The center of Silicon Valley Bank has its own unique problems, but it also has common problems in the macro environment. In a November article, Carl White, Senior Vice President of Regulation at the Fed in St. Louis, noted that while banks will earn more in net interest rate margins by raising interest rates, many institutions may also suffer from falling deposits. Savers may need to withdraw money to subsidize living under inflation, or transfer money to institutions with higher deposit rates. In the article, White stressed that the lack of experience in the short rise in interest rates, combined with uncertainty over the market conditions, poses a challenge to all banks. As financial institutions serving venture capital companies, Silicon Valley Bank and the entire growth sector have experienced a period of rapid expansion with low lending rates. The Fed turned off the cap and cut off the survival of Silicon Valley banks. Many venture capital companies have to withdraw bank deposits to continue to burn money, and the bank's unusually concentrated security assets were also significantly reduced by interest rate hikes, which eventually triggered the worst bankruptcy event of the U.S. banking industry in more than a decade. At the end of 2022, Silicon Valley Bank has a total of $209 billion in assets, including $175.4 billion in deposits. The federal deposit insurance policy is $250,000 per person, and the excess will be redistributed depending on subsequent asset disposal. Professor Saul Omarova, a law professor at Cornell University, says the intervention of the Federal Reserve deposit insurance and its uncertainty, but the result would be not safe for those who put assets in the bank. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.